Most people do not fail to become wealthy because they are lazy. They fail because they are standing in the wrong part of the machine. That is the hard truth I want you to hear before anything else. People talk about wealth as though it were mainly a question of effort. Work harder, get up earlier, stay later, grind longer, want it more. Those phrases sound respectable, but they are incomplete in the way half. Truths are always incomplete. Effort matters. I admire effort. I have spent my whole life around people who worked hard, but if effort alone were enough, millions more people would be rich than actually are. The world does not pay everyone the same way for the same amount of strain. One person works 60 hours a week and never gets ahead. Another works 60 hours a week and slowly becomes independent. A third works fewer hours than either one and still becomes vastly wealthier. Why? Because wealth is not mostly about how tired you are. It is about what you own, what system you are inside, and whether your effort creates something that can grow without asking your body for permission every day. Once you understand that, the whole game changes. You stop asking only how hard should I work. You start asking a much better question. Is it buying groceries and bills only? Is it buying a little temporary comfort? Or is it buying an asset, a machine, an ownership position, a stream of future cash that can survive even when I am no longer standing at the controls? That is the dividing line. And when I boil the matter down as far as I can, I keep arriving at the same conclusion. There are only 3 honest ways for an ordinary person to become truly wealthy. You can build the machine, you can buy the machine, or you can enter a machine built by someone else, extract a great deal of income from your position inside it, and then turn that income into ownership before your lifestyle consumes it. Everything else is a variation, a derivative, or a fantasy sold to people who are too impatient to study structure. I do not say this as philosophy. I say it because I have watched money for too long to believe in comforting nonsense. The first path is to build the machine. This is the path the public romanticizes most and misunderstands most. People call it entrepreneurship, but they usually picture the wrong thing. They picture passion. They picture hustle. They picture a founder giving speeches in a black turtleneck or pacing around a warehouse on no sleep while dramatic music plays in the background. That is cinema. Wealth does not care about cinema. Wealth cares about ownership of a value-producing machine that can scale. That is what a business really is, a machine that solves a recurring problem for enough people, in a repeatable enough way, at a large enough margin, that the equity in the machine begins growing much faster than the founder's personal labor ever could. That is why founders get rich in a way salaried people usually do not. Not because founders are morally superior, not because they are always smarter, because equity scales and wages usually do not. If I earn $300,000 a year from my own labor, that is still a linear arrangement. My money rises because my effort, my skill, my negotiations, or my position have moved higher. Fine. That is better than making $30,000. But it is still labor tied to a human body and a limited calendar. A business with retained ownership behaves differently. If I own 60% of something that grows from $1 million in revenue to $10 million, or from $10 million to $100 million, the increase in my wealth is not linear to the hours I personally worked that year. The market begins valuing not only what the business is now, but what it can become. That is where wealth appears in size. People like to say entrepreneurs take big risks. Sometimes they do. What they are really doing, when it works, is building leverage. Not debt leverage in the narrow sense, economic leverage. They create a system where each additional customer, each additional location, each additional subscription, each additional contract, each additional unit sold does not require a full new life from the founder. That is why the first path is so powerful. A cafe run entirely by the owner's daily labor is not yet a wealth machine. It is often just a difficult job wearing a heroic costume. A cafe with systems, replicable economics, margin discipline, multiple locations, and management that can function without the founder at every register begins approaching a wealth machine. The public misses this distinction constantly. They think building means opening something. No. Building means creating something that can detach from you and still expand. If it cannot detach from you, then you have built employment for yourself, not scalable wealth. That is one reason so many businesses never create freedom for their founders. The founders never build distribution, systems, and operational repeatability strongly enough for the business to stand on its own legs. Then there is ownership. This matters even more than most people understand. A person can help build a machine and still not become wealthy if he gave away too much of the equity before the machine became powerful. This is one reason the first path is so brutal in execution. You must identify demand correctly. You must create a real solution. You must standardize delivery. You must find distribution. You must defend margin. And while all of that is happening, you must retain enough ownership that the upside still belongs meaningfully to you. Most people fail long before that. They build something good that never reaches scale, or something scalable that never reaches distribution, or something with demand but no margin, or something valuable where they surrendered so much ownership so early that the machine can become large without making them wealthy in the way they imagined. That is why I say the path is simple to state and hard to live. Build, retain equity, scale. But living inside those three words is a great deal of pain, unstable income, emotional exposure, uncertain identity, a period where your peers may look safer and smarter while you are carrying all the volatility yourself. That is why not everyone should build the machine. The public loves to shame people who prefer stable employment. I do not. Volatility is the price of founder equity. Not everyone is built to pay that price, and pretending otherwise only produces misery. Still, when it works, there is nothing else quite like it. Because the founder is not being rewarded mainly for labor, he is being rewarded for control over a scalable asset. And scalable assets create wealth in a way salaries rarely can. Now let me say something the public almost never says honestly enough. Timing matters here. Not because timing is everything, because a merely decent business built inside an expanding system can sometimes outrun a better business built inside a shrinking one. That is just reality. A founder inside the early mobile era, the early cloud era, the early semiconductor build-out around artificial intelligence, or a period of strong structural demand may look like a genius partly because the current beneath the boat was flowing in the right direction. I do not say that to diminish accomplishment. I say it because markets are ecosystems, not morality plays. A person who enters a growing system has wind at his back. That wind can be the difference between a very good life and generational wealth. The second path is to buy the machine instead of building it. This is the path I know best, and this is the path most ordinary people underestimate because they have been conditioned to think only founders become wealthy. Not true. Founders create one class of large fortunes. Owners create another. If I buy ownership in productive assets, and I leave that ownership in place long enough, I do not need to invent the machine personally. I only need to own enough of its economics and allow the compounding to do the work. This is where the public gets confused about investing. It thinks investing is a contest of brilliance. Finding the next big thing, out-predicting everyone else, catching the exact bottom, selling the top, buying the hot stock before the crowd notices. That style of thinking sells newsletters and destroys households. The real investor path is simpler and more demanding at the same time. Accumulate capital, allocate it into productive assets, reinvest the cash flow, repeat over a very long time, avoid catastrophic mistakes. That is it. This path is much calmer than building when done properly, but it has its own form of brutality, not operational brutality. Psychological brutality. Because the gains are slow at first and the public hates slow beginnings, people underestimate the power of compounding because compounding is rude in the early years. It asks for consistency before it offers visible drama. If I put $20,000 to work each year into productive assets, the early progress feels almost insulting. That is how many people interpret it. They say, after all this discipline, that is all. Then they quit right before the curve begins bending. The public loves straight lines. Compounding is not a straight line. It is a curve, and that means the later years look wildly different from the earlier years, even if the investor's discipline stayed almost boringly similar. That is why the investor path belongs to people who can tolerate delayed applause. If you need to feel rich every quarter, this path will torture you. If you can quietly own productive assets while the world keeps trying to distract you with excitement, this path can change your life. But we must define productive assets properly. A productive asset is not anything with a ticker. It is not anything other people are discussing online. It is not a collectible story that everyone hopes someone else will later buy at a higher price. A productive asset either creates cash flow, owns earnings power, or appreciates over time because the underlying economics justify a higher claim on future cash. A broad market index fund qualifies. A sound rental property can qualify. A well-priced ownership stake in a business can qualify. A basket of companies that keep generating profits and sending some of those profits back to owners qualifies. Something that has no real cash flow engine and depends purely on the next buyer's excitement is a different species. People hate hearing that because speculation feels more alive than patient ownership. Still, wealth has generally flowed through ownership of productive systems. If I own a great business, that business wakes up and works, whether I am in a good mood or not. If I own shares in a large collection of profitable businesses, the whole productive economy is helping me. That is why I have always loved businesses more than predictions. Businesses make money. Predictions make noise. Now, the investor path depends on one invisible ingredient so important that most people still do not fully appreciate it. Time, not as a slogan, as a force. Time is what turns ordinary returns into astonishing results. A person who earns 8% once has not done anything miraculous. A person who earns 8% and then leaves the gains in place, adds fresh capital, reinvests distributions, and repeats for 20 or 30 years is participating in something very different. At that point, the growth stops looking linear. It begins looking almost impolite. That is what compounding really is. Not a finance formula, a delayed unfairness in your favor. But again, only if you remain present long enough. That is where many people fail. Not because they bought bad assets, because they interrupted the process. They sold from fear, they chased from envy, they withdrew from boredom. They stopped contributions when life became noisy. They changed strategy every time the last strategy stopped flattering their ego. The machine works best when not constantly interrupted. This is why I care so much about simplicity. A broad, low-cost index fund is not intellectually glamorous. Good. Neither is drinking water. That does not stop it from being useful. If a person can own the productive output of the economy at very low cost, contribute consistently, reinvest cash flow, and keep doing so through the years when nothing about the process feels dramatic, that person is doing something very powerful. He is buying machines instead of trying to guess moods. The third path is the bridge between the first two. Join the machine, get paid well inside it, then convert income into ownership before the lifestyle eats it. This is the path many people should understand better, because it is the most accessible form of transition from labor to capital. Not everyone can build a company. Not everyone starts with meaningful investable capital. Fine. Then the rational move is to enter a system where the economic leverage is large. Finance, technology, enterprise, law at high levels, energy, capital allocation, corporate leadership, businesses where your skill touches large amounts of revenue, savings, assets, or risk. Compensation follows leverage. That is why one excellent software engineer building products used by millions is paid differently from an equally hard-working man doing narrow internal tasks inside a tiny business. That is why one deal maker on billion-dollar transactions can be paid differently from another professional of similar intelligence in a lower leverage corner of the economy. I am not making a moral claim. I am making an economic one. The world pays according to the scale of consequences. The trouble is that many people stop at the wrong stage. They join the machine. They become high earners, and then they mistake income for wealth. That is one of the most expensive confusions in modern life. Income is not wealth. Income is material that can become wealth if treated correctly. A person earning $400,000 a year while living on $380,000 may look richer than a person earning $150,000 and investing $50,000 every year. He may also be much more fragile, because if the lifestyle expands to consume the income, then the machine you joined is enriching your present but not liberating your future. That is a tragedy dressed like success. This is where the bridge path becomes so interesting. If you enter a high-value system and you keep your personal overhead sane, then each year of high earnings can be converted into ownership. Bonuses become index funds. Stock grants become diversified productive assets. Profit participation becomes real estate, private business stakes, or broad market ownership. Every year you are inside the machine, you are slowly buying your way out of dependence on the machine. That is intelligent. That is how labor begins turning into capital. This path has phases. First, you develop a scarce skill, something economically valuable, not an identity hobby, not a fashionable surface skill, something that moves revenue, saves costs, allocates capital, manages risk, builds systems, closes sales, or creates value at scale. Scarcity creates pricing power. Then you choose your system. This matters more than many people appreciate. A great skill inside a weak system still caps your future. A strong skill inside a scaling, capital-rich system can change everything. Then you move closer to the money, closer to decision making, closer to equity, closer to This is where many capable people get stuck. They remain important but not powerful, useful but not well positioned. They work hard in a large machine while somebody else owns the upside. Then if they finally get access to high income or equity compensation, they do the worst possible thing. They translate it into lifestyle immediately. That is how wealth dies before it is born. The right move is conversion. Aggressive conversion. Do not tell yourself you will start investing seriously after the bigger house, after the nicer car, after the upgraded vacations, after the private school, after the social image is fully funded. That is how people spend a decade inside the machine and exit with surprisingly little to show for it. If the bridge path is going to work, the income must be transformed into ownership quickly enough that the lifestyle never gets the first and final claim on every raise. That is one reason I have always admired people who looked less rich than their income would allow. Very often they are not failing to enjoy their success. They are capitalizing a machine, and capitalizing a machine matters more than displaying one. Now, here is the unifying truth beneath all three paths. Wealth flows to ownership. That is the common law. Build and retain the equity, buy and hold the productive asset, or earn a lot inside the system and convert the income into ownership before life expenses absorb it. Three paths, same destination. Ownership. This is why most people stay outside wealth even while working very hard. They live entirely in the wage world. Every month income arrives and every month income leaves. There is no growing stock of assets quietly widening the gap between what they need from labor and what the world is already paying them in capital. That is what wealth really is. Not just more consumption, a different relationship to effort. A person without assets must work to live. A person with enough assets lives partly from what his capital is doing while he sleeps. That is a completely different life. People talk about freedom in dramatic language. Freedom is much more practical than that. Freedom is not needing to say yes to everything. Freedom is optionality. Freedom is being able to leave an ugly arrangement. Freedom is having cash flow that comes from systems you own rather than from moods you must survive. That is what all three wealth paths are trying to create. Now I want to say something that many people do not want to hear. None of these paths are easy. Building is emotionally violent. Buying is psychologically boring. Bridging through high income requires discipline so uncommon that most people never practice it, even when the opportunity sits right in front of them. The reason wealth is not more common is not because the principles are hidden. The principles are almost embarrassingly clear once you see them. The reason wealth is uncommon is that the execution collides with human weakness at every stage. The founder gets diluted, scales badly, or quits before the distribution engine matures. The investor gets bored, sells, chases, speculates, or interrupts the compounding process. The high earner confuses income with wealth, expands the lifestyle, and arrives at 50 surprised that the machine he joined never became his. That is the real difficulty, not mystery temperament. Temperament is the tax. A person who can tolerate uncertainty may build. A person who can tolerate boredom may buy. A person who can tolerate looking less rich than his paycheck says he may successfully bridge from labor into ownership. Those are not technical skills. Those are emotional strengths. I have always believed markets are hardest on people who need the market to flatter them. A founder who needs certainty will suffer. An investor who needs speed will suffer. A high earner who needs status will suffer. The machine does not care about those needs. It rewards structure. So if I were speaking to a young person today who wants to become wealthy, I would not ask first what he is passionate about. Passion is nice. It is not structure. I would ask him which path truly fits his temperament. Can he build and endure volatility while retaining meaningful ownership? Can he live below his means, accumulate capital, and buy productive assets relentlessly for decades? Can he enter a high-value system, become exceptional inside it, and convert a large percentage of the resulting income into ownership before success gets translated into consumption? That is the right question, not which path sounds coolest, not which path makes for the best online identity. Which one can you actually live? Because a mediocre path lived with consistency will beat a superior path abandoned halfway through. That is another truth people hate. They want the best plan in theory. I want the best plan in behavior. Behavior is where... And now I will tell you one more thing the public gets wrong. It thinks wealth appears when the asset becomes large. No, wealth usually begins long before it appears. It begins when the pattern changes, the founder stops thinking like a worker and starts protecting equity as the engine of the future. The investor stops thinking in excitement and starts thinking in accumulation. The high earner stops celebrating raises with bigger obligations and starts buying permanent claims on future cash. That is when wealth begins. The visible size comes later. This is why the early years of any of these paths feel so strange. The founder feels unstable before he feels rich. The investor feels underwhelmed before the compounding curve bends. The high earner feels austere while peers look shinier for a while. The machine is being built in secret before it becomes obvious in public. That is normal. In fact, I would go further. If the early stage does not feel a little strange, a little unglamorous, a little unfair compared with what everyone around you is showing off, you are probably not doing it right. The machine almost always looks boring before it looks powerful. That is the test. Can you keep going while it looks boring? Most people cannot. That is why the people who can are eventually paid so differently. So if you ask me how to become wealthy, I will still give you the same answer after all these years. There are only 3 honest ways: build the machine and keep the earn unusually well inside it, and relentlessly convert that income into ownership until labor becomes optional. Everything else is mostly decoration. And once you understand that, a great deal of confusion disappears. You stop expecting wages alone to save you. You stop treating income as the finish line. You stop believing that brilliance without ownership is enough. You stop confusing spending power with wealth. You stop asking the world to reward effort in the abstract and start asking a much more useful question: what exactly do I own? That is the right question, because in the end, wealth does not belong to the person who worked hardest in some sentimental sense. It belongs to the person who built, bought, or converted his way into scalable ownership and then stayed sane long enough for the arithmetic to become visible. That is how reality works. It may not flatter everyone equally. It is still the truth. And truth, even when it is not fashionable, remains a better guide than all the nice stories people tell themselves while wondering why all their effort still belongs to someone else.